I was pulling up vault data this morning, standard Thursday routine, and something made me stop cold. The Shanghai Futures Exchange just reported physical silver deliveries that don't match what's supposed to exist. Not a rounding error, not a data glitch. We're talking about a mismatch so large it suggests one of two things. Either China has been quietly accumulating silver off market for months, or the paper silver market we've all been trading against is about to discover it sold contracts backed by metal that was never there. I'm a private commodities analyst. I've been stacking physical silver for 12 years, and I built this channel because I got tired of waiting half a day for Bloomberg to catch up to what I was already seeing in the data feeds. So let me be direct. What happened in Shanghai overnight is the opening move of what could become the largest forced short squeeze in precious metals history. And if you're holding paper silver right now, or worse, if you're short, you need to understand the mechanism that's about to unfold. Let me back up for a second. China just did something unprecedented. They opened the Shanghai Gold and Silver International Board to direct foreign participation, effective immediately. It's not the headline. The headline is what came with it. A standing bid for physical silver at prices roughly 3 to 4% above the London spot fix. That doesn't sound like much until you realize what it means structurally. For decades, the global silver price has been set in London and New York. COMEX in New York, the London Bullion Market Association. These are paper markets. Most contracts never see physical delivery. It's a ledger system where banks trade obligations to deliver silver, not actual bars moving through vaults. And that worked fine as long as everyone agreed to play by the same rules. Cash settlement, rollover, rinse and repeat. But China just said, we don't want your paper, we want the metal. And we're willing to pay a premium to get it, immediately. Here's why that's a problem for the existing market structure. If you're a bullion bank, let's say you're one of the big five that make markets in silver, you've sold futures contracts assuming you can either roll them forward or settle them in cash if things get tight. Your entire business model depends on the assumption that physical demand stays predictable and that most traders don't actually want delivery. You're leveraged maybe 50 to 1 on paper silver versus what you hold in allocated vaults. That's not a conspiracy theory. That's just how fractional bullion banking works. It's legal, it's disclosed in the fine print, and it works perfectly until someone shows up and says, I want all of it. Now, that's what China just did. I pulled the latest data from the Shanghai vaults about 2 hours ago. In the last 48 hours, we've seen physical silver inflows into Shanghai bonded warehouses jump by 8,000 metric tons. That's roughly 257 million ounces. For context, global mine supply for an entire year is around 830 million ounces. In 2 days, China just absorbed the equivalent of almost a third of annual global mine production. And they're not slowing down. The bid is still live. Now let's talk about what this does to the paper market. If you're a short seller, or if you're a bullion bank that sold futures contracts, you now have a decision to make. You can either deliver physical metal into your contracts, or you can buy back your position and close it out. But here's the trap. If you try to buy back your short position, you're buying from a market that's currently being drained of physical metal by a buyer who's offering a premium and has functionally unlimited currency reserves. Every time you try to cover, you're bidding against China. And China doesn't care about quarterly earnings. They care about strategic accumulation. This is what I call the short squeeze from hell. It's not a Reddit forum buying shares. It's a sovereign nation with $3 trillion in foreign reserves systematically draining the physical silver market, while the paper market pretends everything is fine. Let me pull this apart so you can see the mechanics clearly. Think of it like this. Imagine you sold 100 IOUs for silver bars, but you only have 2 actual bars in your vault. That's fine as long as nobody asks for delivery at the same time. But now imagine someone shows up and says, I'll buy all 100 bars and I'll pay you extra to deliver them today. Suddenly, you have to go into the open market and buy 98 bars you don't have. But the guy who's buying from you is also buying in the same market. You're bidding against your own customer. And he has more money than you. That's the structural trap we're looking at right now. The COMEX reported open interest in silver futures yesterday at just over 173,000 contracts. Each contract represents 5,000 ounces. That's 865 million ounces of paper silver. The COMEX registered vaults, meaning the silver that's actually available for delivery, hold about 62 million ounces. That's a ratio of 14 to 1. 14 paper claims for every ounce of deliverable silver. And that's assuming every ounce in those vaults is actually unencumbered, which is a generous assumption. Now add China's bid into that equation. If even 10% of those paper longs decide they want physical delivery instead of rolling their contracts, we're talking about 86 million ounces of demand hitting a system that holds 62 million ounces of registered inventory. The math doesn't work. Something has to break. And here's where it gets even more interesting. I was looking at the lease rates for physical silver this morning. The 1-month lease rate just spiked to 4.2% annualized. That's the highest it's been since the March 2020 chaos. Lease rates are what bullion banks charge to borrow physical metal. When lease rates spike, it means there's a scramble for physical. It means someone, somewhere, is scrambling to find metal they promised to deliver, and they're willing to pay a premium to borrow it just to avoid defaulting. Let's talk about what happened the last time we saw this pattern. March of 2020. COVID lockdowns, mints shut down, refineries shut down, physical premiums for silver eagles went from $2 over spot to $12 over spot in a matter of weeks. The futures market kept trading like nothing was wrong, but if you actually wanted to buy a physical coin or bar, you couldn't find it. And when you could, you paid double. That was a supply shock caused by logistics. This time, it's a supply shock caused by sovereign accumulation. And it's happening while global mine supply is flat and industrial demand for silver, solar panels, EVs, electronics is at record highs. Here's the part that most people are missing. China isn't doing this to make money on a trade. They're doing this to secure a strategic resource ahead of a currency transition. Silver is not just a monetary metal. It's the most conductive element on the periodic table. It's irreplaceable in high-efficiency solar panels. It's critical for EV charging infrastructure. If you believe the world is transitioning to green energy, and China is betting everything on that transition, then silver is as strategic as oil was in the 20th century. And China just realized the West has been letting them buy it at artificially suppressed prices for years. So what's the play here? What's the thing that tips this from a tight market into a full-blown squeeze? The tripwire is COMEX delivery failures. If we see a major bullion bank fail to deliver into a futures contract and offer cash settlement instead, or worse, if we see a force majeure declared on a contract, that eggs the signal that the paper market has lost credibility. And once that happens, every institutional player who thought they had silver exposure through ETFs or futures is going to panic and try to convert to physical. And there isn't enough physical to go around. I'm watching the April COMEX contract expiration like a hawk. That's April 28th. We've got about 12 weeks. If delivery demands start stacking up and the registered inventory starts draining, we're going to see a spike in volatility that makes the 2011 run to $50 look like a warm-up. And I'm not saying that to hype you. I'm saying that because the structural setup is worse now than it was then. In 2011, there was no sovereign buyer hoovering up physical at a premium. This time, there is. Let me tell you what I'm doing. Not advice, just transparency. I've been stacking physical silver for over a decade. Rounds, bars, constitutional silver. I'm not touching paper. I don't care what the futures price says. If I can't hold it, I don't own it. That's been my rule since I watched the paper gold market get smashed in 2013 while physical premium stayed elevated. The paper price and the physical market can decouple. We've seen it before. We're about to see it again. My personal plan is this. I'm holding my physical. I'm not selling into this move. I'm watching the COMEX inventory reports every single day. If I see registered inventory drop below 40 million ounces, that's my signal that we're in the endgame. At that point, I'm looking for paper price to become completely irrelevant. Physical premium is what's going to matter, and I'm positioning for that. I'm also watching the Shanghai premium. Right now, it's 3 to 4%. If that widens to 8 or 10%, that tells me the physical shortage is accelerating. It means even at elevated prices, China can't get enough metal fast enough. That's when the real panic starts in the West. Here's the thing most people don't understand about short squeezes in commodity markets. It's not like a stock squeeze where the price goes up and then comes back down when shorts cover. In a physical commodity squeeze, if the shorts can't deliver, the market can lock up entirely. Trading can halt, contracts can get cash settled at prices that have nothing to do with the actual value of the physical metal, and the people holding paper get stuck with whatever the clearinghouse decides is fair, which is never actually fair. I've seen this play out in smaller markets. Palladium in the early 2000s, rhodium in 2021. When physical supply disappears and industrial users start panicking, the price doesn't just go up, it gaps. You wake up one morning and the metal you thought you could buy at $30 an ounce is suddenly $60. And there's no inventory. That's not a prediction. That's a pattern. And the setup for silver right now has all the same ingredients. Let's talk about the timeline. If China keeps this bid live and physical keeps flowing into Shanghai, we're looking at a drawdown of available Western inventory over the next 60 to 90 days. The COMEX and LBMA have maybe 4 months of buffer at current delivery rates. But if the delivery rate accelerates, if more longs stand for delivery because they see what's happening, that timeline compresses. The other wild card here is the ETFs. Funds like SLV hold physical silver in trust. But the fine print allows them to settle in cash under certain conditions. If we hit a point where the ETFs can't source metal to meet redemptions, they're going to halt creations or shift to cash settlement. And the moment that happens, anyone who thought they had silver exposure through an ETF is going to realize they just have a claim on dollars, not metal. That's when the real stampede into physical starts. I want to be very clear about something. I'm not saying silver is going to the moon tomorrow. I'm saying the mechanism for a violent repricing is now in motion. And the thing about mechanisms is they don't care about sentiment or hopium or technical charts. They care about supply and demand and contract obligations. And right now, the obligations are bigger than the supply. That's just math. Here's what I'm not doing. I'm not chasing paper silver on leverage. I'm not buying out of the money call options hoping for a miracle. I've been in this market long enough to know that when volatility spikes, the brokers will hike margin requirements and force liquidations at the worst possible time. If you're leveraged when this thing breaks, you're going to get wiped out, even if you're right about the direction. The system is designed to shake out the retail traders before the big move happens. So my position is physical, boring, unsexy. But it's the only position that can't get margin called or cash settled or force majored out of existence. If I'm holding a silver eagle in my hand, nobody can tell me it's worth zero because a clearinghouse ran out of inventory. That's the edge. That's the asymmetry. Now, let's talk about what happens if I'm wrong. What if China's bid is a head fake? What if they're just trying to corner a short-term supply advantage and they pull the bid in 2 weeks? Here's the thing. Even if they pull the bid, they've already exposed the fragility of the paper market. Every bullion bank on the planet just got a reminder that physical demand can appear out of nowhere and overwhelm their fractional reserve system. That knowledge doesn't go away. The next sovereign buyer, maybe India, maybe Saudi Arabia, now knows the playbook. You don't need to squeeze the whole market. You just need to demand delivery on enough contracts to expose the leverage. And once that happens, it's going to keep happening. The genie doesn't go back in the bottle. So even in the scenario where this specific squeeze fizzles, the structural risk has been revealed. And that revelation alone is going to change behavior. Institutions are going to want more allocated physical. Central banks are going to start asking harder questions about their bullion bank custodians. And retail stackers, people like you and me, are going to stop trusting the paper market entirely. That's the real shift. It's not just about this one trade. It's about the loss of confidence in a system that's been running on trust and leverage for 50 years. Once that confidence cracks, it doesn't matter what the spot price says. Physical is going to trade at a premium. And that premium is going to widen until the system either reforms or collapses. Let me give you a concrete example of what I'm watching. The US Mint just reported sales of silver eagles for January. They sold 4.6 million ounces. That's the highest January on record. Retail demand is already elevated. Now add institutional demand. Now add China. The math doesn't work. The mine supply isn't elastic. You can't just turn on a silver mine overnight. It takes years to bring new supply online. And recycling CA ain't fill the gap because most industrial silver is used in trace amounts and never recovered. We're looking at a structural deficit that's been masked by paper market manipulation for years, and China just decided to call the bluff. Here's my personal read on the next 60 days. If the Shanghai bid stays live, we're going to see COMEX registered inventory drop below 50 million ounces by mid-March. When that happens, the premiums on physical silver are going to start widening in the retail market. You're going to see delays at the big dealers, out of stock signs, rationing. That's the early warning signal. That's when the general public starts to realize something is breaking. If inventory drops below 40 million ounces, we're in crisis territory. At that point, I would expect emergency measures. Maybe the COMEX changes contract specs. Maybe they halt trading. Maybe they force cash settlement. I don't know what the specific response will be, but I know there will be a response because the alternative is a cascading default that takes down multiple bullion banks. And the system won't allow that. But here's the thing. Whatever emergency measures they take, those measures are going to destroy confidence in the paper market. If you're a pension fund or a hedge fund that bought silver futures, thinking you had real exposure, and then you get force settled in cash at a price that's 20% below the physical premium, you're never trusting that market again. And that loss of trust is permanent. So what's the end game? One of three scenarios. Scenario 1, China gets satisfied, pulls the bid, and the market stabilizes at a higher price level with wider physical premiums. That's the soft landing. Scenario 2, the COMEX and LBMA run out of deliverable inventory. We see defaults or force majeure, and the paper market loses all credibility. Physical silver decouples entirely and trades at a massive premium to whatever the futures price says. That's the hard landing. Scenario 3, we see a coordinated intervention. Maybe the US releases silver from the strategic stockpile, which, by the way, was mostly sold off in the 90s and 2000s, so there's not much left. Maybe the big central banks coordinate to flood the market with leased metal to suppress the price. That's the bailout scenario. My money is on scenario 2, and here's why. The strategic stockpile is gone. The central banks don't have enough physical silver to flood the market. And China has already demonstrated they're willing to pay a premium, which means any intervention would just result in China buying even more metal at a higher price. The West doesn't have the ammunition to fight this. They sold it all over the last 20 years, assuming industrial demand would stay predictable and nobody would ever challenge the paper market structure. They were wrong. So here's where we are. The short squeeze from hell has started. It's not dramatic yet. It's not on CNBC yet. But the mechanism is in motion. The data is clear. And if you understand the structure of the bullion banking system, you understand why this can't be easily stopped. I'm holding physical. I'm watching the inventory reports daily. And I'm not selling until I see either a resolution of the supply crisis or a complete decoupling of the physical and paper markets, whichever comes first. This is not financial advice. This is just one stacker telling you what he's seeing in the data and what he's doing about it. You make your own decisions. But if you're holding paper silver right now, I'd be asking some hard questions about whether that contract is actually going to deliver when you need it to. The next 60 days are going to be wild. If you're stacking, stay calm and keep stacking. If you're trading paper, understand the risks you're taking. And if you're short silver right now, God help you, because China is on the other side of that trade. And they're not backing down. That's all I've got for today. The data will keep updating. I'll keep watching. And if something major breaks, you'll see another video from me within hours, not days. Because that's the whole point of this setup. Speed. Real information. No waiting for the mainstream narrative to catch up. Stay sharp out there.